With the U.S. housing market severely needing more inventory, the solution very well could be in renovation lending. What is renovation lending and how could it help create the inventory home buyers desire? You'll need to tune in to find out. Are you ready to go? Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and a very special guest. I've been trying for 2 years to get this guy on the show. Originally from Chicago, Illinois, he is now a Florida native. For multiple years, he was that knight in shining armor for our alma mater, the University of Central Florida. He comes from the mortgage family, the Minglardi family. He's a second generation mortgage banker. He is my friend, Joe Minglardi. Joe, welcome to the Loan Officer Podcast.
Hey, Dio. It's good to be here, man.
Yeah, how'd you like that intro?
That was great.
Yeah.
I need a recording of that.
Yeah, it came off the top rope for you.
Yeah, it was good.
That would be awesome if you did like a recording of that and then put it behind like a really cool bass beat, like some house music.
Yeah.
Oonce, oonce, oonce. And then next time that you go to like Cross Country Mortgage's award ceremony and you're winning some big fat award for production.
That's it.
That it's that intro, but looped over some of that house music.
Yeah, I know what I'll be working on this weekend.
Yeah, or for you, probably banjo music. But nonetheless, you can throw a little banjo in there and we'll get the equestrian side of you.
Yeah, you got it, man.
Yeah, not many people know that about you. So,
we threw that right out there.
Yeah. So you were a mascot in college.
I was.
Yeah, and you went to UCF, Go Knights, right?
Go Knights, charge on.
And you got to be not Nitro.
No, so it was the Golden Knight. There's two, basically, at UCF. So you have Nitro, everyone knows and loves Nitro. And you have the Golden Knight that rides the Pegasus horse out in front of the team and during orientation and tailgates, and that's what I did.
Yeah, that's always a fun fact that you did not grow up riding horses.
Not really, no.
Yeah, according to your father, who, by the way, Joe's father, John's a mentor of mine. Like, to me, he's a who's who in the mortgage business. He's quasi-retired now. But your father and your uncle started a mortgage companies. They sold mortgage companies. They helped run mortgage companies for decades. And that's actually how I met your father and eventually met you. And then I will look forward to meeting your brother when he moves from Chicago down to
a few months
down to Florida, which is going to be exciting for you guys.
Absolutely.
But yeah, you fell in love with wanting to be a knight. You were like a performer at medieval times. If you all know what that is,
story.
If you have a medieval times in your market, and then you parlayed that into being your college's mascot, where you got to ride the horse in your armor onto the football field for games.
Right.
Yeah,
that's
pretty freaking
interesting
awesome.
Experience. Yeah.
That's pretty freaking awesome. And then you fell in love with a horse girl.
That's right.
Yeah, and now she rides. Do your daughters ride?
Yeah, well, she's trying to get them too. I'm trying to keep them away from it.
Yeah, it's an expensive sport.
It is.
It's an expensive
No, yeah, she
sport.
does. We have a horse here in town, and it's a regular part of our life now.
So such a cool backstory. Like the things that you get to learn about as you get to know people outside of work.
Yeah,
right. Like, but when I met you and when I first heard of you, it literally, true story, and this is why we're doing today's episode. It was like, hey, if you need a renovation loan, right? And for me, that's FHA 203K.
Sure.
Or that's home style renovation. Now, you've already corrected me off camera. Well, there's way more than just those two. There's VA, there's USDA. Cool. But the two most popular, FHA 203K, then home style. But when I first heard of your name, it was like, hey, look, if you want to not do that loan and you want to refer it to someone who does a good job, yeah. There's this kid, Joe, and there's this kid, Nick. You and Nick worked together at the time. Those two guys are crushing it with that product. And if I was going to do a show on that product, I knew it couldn't be me. I knew it had to be me with somebody else. So I'm super grateful that it gets to be you because as I introed it, I do believe that in many markets, we are going to have to create the inventory we desire. Because I'm seeing that home buyers right now are looking at the homes that are on the market and like, oh, that's all I can afford. That home needs a lot of work. Or it's the exact opposite. Like, I want that house, that thing looks beautiful, but ... I can't afford it, right?
Right.
And I think renovation lending is a way for people to slide in on many cases and make home ownership more readily available, make home ownership more affordable. And I want to sit here and utilize you as the subject matter expert to actually talk in detail how the consumer or how the real estate community can embrace renovation lending to create the inventory that we so need and desire as a country, or in other aspects, how can we make homeownership more affordable?
Sure.
I.e., wink, wink, nod, nod. Could I maybe one day do a renovation loan, add an accessory dwelling unit, i.e. an ADU, then use the rental income on that ADU to offset the mortgage payment? Now the mortgage payment is something I can afford and I qualify. Yes or no, is that something I can do with renovation lending?
Huge. It is.
Huge.
And that's a hot topic right now, the ADU. So we'll get into that for sure.
Yes, and that's a teaser for anyone who's made it this far. You're going to want to listen. You're going to want to tune in. So renovation lending, where do you want to start with this?
Let's go, Dio. What a kickoff to this thing. And as you can see, we got our hard hat here because whenever you talk renovation, right, you got to practice safety.
As you can see, only if you're on the TLOP YouTube channel and you're subscribed. But there you go.
There you go. So I want to start by thanking you for plugging Nick, because that's really how this whole thing started. So when I got into the industry, I was a junior LO for this young, up and coming, very powerful, very talented loan officer, Nick.
Shout out Nick Long with Guaranteed Rate.
Yeah, good guy, good friend.
Yeah, and his dad too, mentor of mine.
That's it.
Yeah, another second generation. You know, yeah.
We were the next gen, team next gen. So he found a niche with renovation lending, and because I was his junior LO, I had to learn it because that's what he did. And I started realizing the power and the opportunity behind these loan programs, how much it really offered. Now we're in this paradigm, this type of market where it truly is an opportunity for so many folks to get into homes, as we've seen housing prices increase, interest rates increase. We know there's a lack of inventory, so we've seen builders speedily try and put new homes up. So it's a lot of competition for turnkey new construction homes. Before, it was a great niche product to offer and say, hey, look at this great thing you can do to this house that needs a little TLC, or maybe a complete rebuild.
Well, and what I liked about what you and Nick were doing, and it's rare, like these are outliers. That's why we talk about you all, but you all looked at what the rest of us were doing in the market and you're like, what if I started doing the things that they're not willing to do?
Right.
And it started that way.
It did.
But I don't think, and what we're going to talk about today, I don't think that's the way it's going to be going forward.
The big hope is that we see this utilized far more than we have in the past.
Yeah.
Now, coming off of the pandemic, coming off of a lot of these challenges that we've seen in the ultimate construction arena with labor costs and construction costs, and all these things have slowed our normal production rates using some of these programs. Now, that being said, we were just talking, we're coming off a record month at CCM. We had 41 closed units, renovation units for near $18 million. So super proud of that.
That's phenomenal.
Great record for the company, record for our internal renovation team. So it's there. It's being utilized. We need more. And so what you said about how when we started, it was what people weren't doing. So we decided we're going to specialize in it. Unfortunately, that's still kind of the case. And that's why this is really important. I think that we need to get more loan officers, more mortgage professionals, proficient in what these programs are, so that we could then bring them to our real estate partners. Then as a team, we can get it in front of the consumers. It's important on the mortgage level to understand how these programs work and why they're so powerful. Then we have to teach our real estate agents, who we know are smart, bright individuals, right? But we need to be able to show them how to identify when these programs, maybe we didn't start that way, but identify when we can use them so that we can properly then translate it to the consumer. So I think on the face of it, the LOs have to become more proficient. And this is a great opportunity to get it out there and kind of talk about some of these things, why it makes it so powerful. So you mentioned the 203K. Excuse me. 203K is probably the Mac Daddy renovation product.
The OG.
It's the OG.
It's the OG renovation loan.
So somebody calls me and they say, hey, I want to do a renovation loan, or I have questions about the 203K. And we may find out during that conversation that the 203K is not going to help them. There's some other renovation product that will. But the 203K has at least made its way around the market and around the media, that people at least know the name. People in the industry know the name. but they don't know enough about it. So what are these programs? Let's just talk about what these programs are first.
Yeah, I was going to say, because like what I love about what we're doing today, and it so is on brand to TLOP. Like, you know, I have struggled for years. I'm like, don't let the name fool you. Like if you look at the neon sign behind us, it says the shit they don't teach you in school. That's what we like to talk about.
Sure.
And when we make content, we're not making content for loan officers. We're making content because I learned so much about being an adult, about being financially literate, about running a good business because I was a loan officer. So yeah, you're going to talk about LOs. Listen up. Y'all need to learn this. Realtors, listen up. Y'all need to embrace this. Potential home buyers or current homeowners, please know that this financing solution is out there. So basically your content, Joe, is going to encapsulate about 70% of the American populace.
I love it.
Yeah, but let's first start with, because we can't assume that everyone knows what you and I know, what is an FHA 203K? Who does it serve?
Let's start with something a little bit more prophetic.
Okay.
And saying that to the LO, to the agent, to the home buyer, what this is opportunity in so many different ways. So the 203K loan or any of these renovation loans, what they are, face value, is a purchase loan or refinance loan with a construction rider built into it. It's as simple as that.
So I can buy the house and finance in fixing it up.
You got it. And this could be on several different levels.
Okay.
We've seen everything from minor new appliances going in to complete rebuilds. Depends on the need of every individual.
Is there a maximum? Is there a minimum?
Sure. And there's nuance to all these different programs.
Yes.
FHA is going to be different than conventional and VA. So if you have a minor project, you may be looking at FHA 203K limited, right? Or a VA if you're a veteran. Very powerful VA product available for veterans, 0% down renovation product.
So wait a minute. So if I'm a active duty military or I'm a qualified veteran, I can purchase a home, utilize my VA benefits, which means no money down, and finance in rehab.
So good.
Yeah, so good. And you know what I do like, and we will stay away from this, and a little disclaimer, we're not going to talk DTI and LTV and all the geeky mortgage underwriting qualifications. Like, look, if you're a mortgage loan originator, there are resources out there for you to learn the geeky side of things. But what I've learned in our industry, I'm sure you learned it too, and I've swiped and adapted this from my friend Danielle out in Colorado, but it's like so much of what we do, the answer is it depends. So like we're going to keep it high level today, but we do want to at least shine a light on the products, the programs, and just the highlights without having to dig deep into it. But I do know an FHA loan is for someone buying a primary home.
That's correct. Now, all of these agencies have been expanding what they're allowing for income producing properties. So you started off during the intro by mentioning ADUs. Mm-hmm. This is huge. More and more folks are starting to become savvy with ways to make additional income on their properties. So FHA is primary, but FHA with an ADU, an attached ADU, where you can use 30% of the rental income to help qualify, not to mention what you're going to get every month from it.
There's a hack. How about that?
Huge
those kids on TikTok. I just had Jordan Nutter on the previous episode, and she crushes it on TikTok. But could you imagine doing some kind of a TikTok where you're teaching the kids how to house hack? But it's like house hack with an FHA 203K. So FHA means I'm buying a primary home, but I am allowed to use my renovation money to create an ADU, and then I can have that ADU rented out. So I could live in the main building. I could rent out the ADU, and maybe after a year or two, I decide that I want to move across town or I want to upgrade my house. I could keep that home. I could rent out the main home, keep the ADU rented, hope it cash flows, and rinse and repeat. If I do that 5 times over 10 years.
There's your house hack.
Yes.
There's your portfolio.
Yes. I have 10 doors.
Right.
5 properties, 10 doors.
Right.
With other people paying my mortgage.
That's it.
Yeah.
It's a beautiful thing. And knowing your audience is really huge too, how to captivate the audience. So if you are on social media or on some other platform, or you just get a phone call from a young millennial buyer who's coming into the market for the first time, maybe they're single or it's them and a young spouse, no family yet, and they know that they've got the flexibility in their lifestyle to do a little bit of that for the next several years to grow that portfolio. This is a great way. Now, again, nuance to programs. FHA, once you use it, you can't really go on and use another FHA while you've got one out there. So, but there's ways around it, and that's why it's important that we understand how these work.
So the four main ones. FHA has one, right? And FHA, I have to be a primary buyer.
Have to be primary, correct.
Okay. Fannie Mae has their own, or conventional financing has their own, right?
Correct.
That's called home style renovation. Does home style require me to be a primary as
no,
well?
So no. So that's great. So that's where you're going to get into your secondary investment.
So I can buy an investment property using a home style renovation loan.
You got it.
I can buy a vacation home, a lake house, a beach condo,
whatever you're into,
and utilize. Wow,
yeah, that's right.
Okay, what about VA and UST? Those were probably only primaries.
Primary as well.
Okay, so you just keep in mind, like, this isn't necessarily a loan product that fix and flippers are going to use.
Not necessarily, but going back to the home style or the Freddie Mac choice, depending on what works better for you, that technically you can, and there's ways as long as the cost makes sense. Now, in a market like we're in now, where investors are maybe having a little bit harder time finding that marginal cash flow in their investment properties just because of the cost of the housing, interest rates, all of these things, adding the additional, it may make it hard cash-wise to utilize something like this versus using their own cash, cashing out and moving on.
Okay.
So there's always going to be a market where it makes sense, right? You just have to kind of know, again, who you're talking to and what kind of market are you in. But going back to 203K, if we may, because again, probably the most widely used renovation loan.
Yeah.
And not probably.
It's the gold standard.
It is. It is the gold standard.
It's the most popular one.
Now, I'm just going to spit off a couple different ways that we've seen this program become the gold standard. So first and foremost, these are your traditional agency loans, like I said, with the construction rider. So what do we know the down payment on an FHA loan is?
3.5%.
3.5%. It remains 3.5% with this. It's just 3.5% of your acquisition cost. So that's the cost of the purchase plus your renovation piece tied in, right? So staying at 3.5% is huge, right? That's not going to increase on you. This is probably the number one most powerful tool with the 203K. And we heard this together at the MBA event.
Okay,
recently.
by the way, this is a hack. This is a trick. You're going to want to slow down, listen hard, and maybe even take notes. Go ahead.
The FHA 203K is the one program on the market that will allow you to finance on 110% of the after improved appraised value. Okay, so I'm going to go back.
So after improved is key words there. That means after you've made all the improvements, the rehab,
right?
What's the home supposed to be worth? And FHA will let us lend up to 110%. So realtors out there, if you're having appraisal issues, maybe you flip something from an FHA loan to an FHA 203K. Maybe you do some minor modifications like appliances, like a guest bathroom remodel, and maybe voila,
like magic.
Like magic,
that's it.
Your appraisal issue goes away. Like, what a hack.
Huge hack.
What an awesome house hack.
Yeah.
Well, not
and
a house hack the way we know it. That's more like a qualification hack.
Sure. But we always know in most cases, right, unless the house is brand new and you picked everything out, there's something that you can do. There's
Always.
something you want done.
Always.
Right? And we can likely qualify you for an extra 10 grand worth of some minor repair items. Now you get 10% extra. So let's do a quick example if I can.
Okay.
Just so people understand. So in a normal transaction, you buy a home for $300,000, right? We all know if your home doesn't appraise for $300,000, then we have to get back to the table. We have to figure out how are we going to bridge that gap, negotiate with the seller, bring the cost down, do whatever. Now we get 10%, right?
So now we're going to 330.
330.
Okay.
Doesn't necessarily mean the house is worth 330. We get this 10% buffer. So now as long as your all-in acquisition cost with the renovation is 330 or below, we can do the loan. You don't have to spend anything extra. You don't have to renegotiate. So if you're all in at 310, let's say, you're all in at 310, the home appraises at 300.
Well, in this case, they didn't. Let's say it appraised at 290.
That's it.
Yeah, because you still have that 10% buffer.
Well, so, either way you look at it, what we know is that we underappraised.
Yes.
That's the most important thing with this. We underappraised. We underappraised within that 10% buffer. There's no need to renegotiate. No extra cash is brought to the table. We can simply write that loan. You just
no work has to be done. Do I still need to get my FHA? I'm gonna geek out a little bit.
Let's go.
I still have to go get my FHA? What do you call them? Helper guys, the consultant. Do I still have to go through the rigmarole of getting an FHA consultant?
So this is a specific trait to these programs. So you may have a consultant already involved depending on the project, but it doesn't alter just because of the appraised value. What's important here is that you don't have to start making changes to your scope of work to get the total cost back down to where the appraisal is, because you have this 10%.
And maybe my thought process is going a little nefarious here, so I apologize and don't hold it against me. But like, I'm looking for a way to take that frown and turn it upside down. Could I be purchasing a home for $300,000 in this scenario, for $300,000, and I'm not doing a renovation loan, but my appraisal doesn't come in at 300, it comes in at 290. Now, I as a buyer, I'm totally fine paying 300 for it. In fact, I kind of disagree with the appraiser, but I mean, I'm not going to argue. I'm not going to win that argument. It's not worth arguing. Could I just flip my loan from a FHA, it's called standard 203B, but that's geeking out. Could I flip it from a standard FHA to a 203K without doing anything else in order to get that 10% buffer? Or am I now going to have to, wait a minute, I have to bring in the FHA consultant and I'm going to have to do some work. Now that some work may only be $5 or $10,000 and maybe new appliances, I don't know. But like where in the hacking tips and tricks, how much leeway do I have to play?
So you have to do something.
Okay, I have to do something. That was the first.
I know where that's where you're going.
You have to do something.
Right, you have to do something. This is still once you change that loan type to the K, it's going to trigger new disclosures, new requirements. Could have work write-ups, maybe not. Have to have a contractor vetted. We have to have the appropriate documentation.
Okay, possibly a new interest rate, possibly more fees.
Almost certainly a new interest rate.
Yes.
And almost certainly more fees involved.
Yes.
So it's a house hack in. It gets us past this hurdle if all parties agree and want to move forward, and this is a way to do it. And we know there's a couple things that the buyer would be happy to have done.
Yes.
But it's unfortunately not as easy as just saying, let's change the B indicator to a K and call it a day.
Yeah, perfect.
I wish.
Yeah, no, and that's good for people to know, and I wouldn't want someone to get the wrong impression.
Sure.
No different than, we just touched on it, but I'm going to slow it down for this right here. Y'all, and y'all is everybody, that's lenders, that's home buyers, and that's realtors alike. These loans are quote unquote riskier. So in life, when things are riskier, there's a premium you have to pay. So just anticipate when you're doing one of these loans, you may pay an extra $1,000 or $2,000 in fees, and your interest rate may be 0.25% higher. But think about what you're getting. Like, okay, 0.25% higher, you're talking an extra $60 a month and a couple extra $1,000 in fees in order for me to take a home from being not affordable to affordable. I don't qualify. I now qualify. By the way, nobody wants a mortgage. Everybody wants a home. The mortgage is the thing that you dream about never having again, right? So this is still a means to an end. And this 203K, the way that I love to see it is I look at the neighborhood that I grew up in. The neighborhood in Longwood, Florida that I grew up in. Okay, that was 30 years ago. There are still the same neighbors living in that neighborhood. That's a great starter neighborhood. Good public schools, the houses aren't large, the lots are 1/4 acre, but it's safe. Well, the problem with those homes, with those neighbors for 30 years, they haven't updated those homes since 1986.
Well, let's rewind.
And in this 203K or even the home style renovation or the other two, the VA renovation, the USDA renovation, although that neighborhood is not USDA eligible, but that's a geeking out there. What I look at that neighborhood is, you can get in there for 300, but you won't want to live in it for 300. But you would love to live in it for 350. The problem is those sellers are never going to update the home the way that you want it updated, and you don't have the cash as a first-time home buyer to put $50,000 of new paint, new flooring, new appliances, etc. So this loan product, the neighborhood that I grew up in, that I would love to see other young families raise their families out of, is going to require a lot of renovation lending. And if people don't know about the product or they're not introduced to guys like you, then they're going to look at that neighborhood and turn their noses up when really they shouldn't. They should look at that neighborhood and say, I can raise my family there. I just need to find the right tool to help me purchase the home and make it my own.
Well, one of the big things here is that it allows you to focus on a very old but foundational concept with real estate, which is location, right?
Yes.
Location. So we got a little excited. We started talking about ADUs and appraisals and house hacking, and all that's exciting. But if we step back a little bit, you actually brought up a great thing. So right now, the average home in Florida is over 30 years old. And the only reason that it's not older than that is because we have so much new construction going on that is kind of, it's skewing the average.
Which, by the way, people like in Boston or Annapolis, Maryland, they chuckle.
Right.
You were like,
New York,
that's 30 years old. And they're like, our homes are 130 years old.
New York, I think, has the highest. They're averaging around 63 years is the average age of a house in New York. So there you go.
Yeah.
Right? And not that Florida was probably there at some point or very near to it before we had all this construction. Yep. So there's different ways to look at it. So to your point, going into a neighborhood where it's a safe neighborhood, it's been there for a while and it needs to be updated. You are giving yourself an opportunity to get into an affordable house, maybe even at a bargain, which how often do you see that right now, right? Maybe where the sellers are willing to even give you a little something because they know things have to get done. We know you're paying a premium when you go to that new construction house or that recently renovated flip or whatever it might be. You're going to pay more. You're going to have more competition, which means you might even overpay.
Yes.
So not turning your nose up and understanding that there's a lot there. Now, not all of us are DIYers. Not all of us can see the potential that lives within these properties. So it's important for the real estate professionals who are going out and showing these homes to inspire and show what it can be, to understand what that needs list is of their buyers and their clients going out and saying, hey, we have room to do this and our guys have the money to get you there.
Yeah, say don't imagine this house the way it looks. Close your eyes.
Right.
Imagine it has this type of flooring. Maybe it's the wood tile that people love. And imagine having this countertop and these brand new appliances. And imagine the landscape being all redone.
Right.
And what if I told you could have that house for $50,000 less than what you're paying for the new construction house, and it's an established neighborhood in schools that are good schools, and for me, Publix, you Publix, because we're Southeast guys and we love our Publix, and Publix is right down the road. It's like
you're close to work, you're close to your kids' school, your bus stop, all of it. Now, for the real estate agents, this should also be really exciting as well, because one thing we all know is that time is money, right? What we don't want to happen, or what we want to try and help, let's say, our real estates do is cut down showing 100 different homes to clients. We can help our real estate partners bring this down to showing just a handful, maybe one. If you focus on the location, maybe one house, and then saying, here's the things. Now, we've been talking mostly about cosmetic.
Yes.
The wants, right? I want this, I want that. But where these programs also shine is saving situations where otherwise financing can't go through because you have an insurance or a health and safety violation, something where you can't close the loan with traditional financing because of condition. So we have so many situations where folks want to buy the house, and maybe they are DIYers. They're going to do it themselves. They got money saved. And they want to do it. They don't want to spend the extra on having a contract.
Those people are weirdos.
Not me.
That's not.
I'm not one of those people. Yeah, but we have a lot that are, and so they go in to buy the home and then realize through inspections and appraisals that there are subject to conditions. There's deficiencies with the roof, with the plumbing, with the electrical, with what have you. Yeah. Anything that creates issues in closing the deal. So then, well, how are we going to do this? The seller can't give us. They won't, or they can't give us anything. We don't want to put money into a house we don't own yet up front to close.
Of course not.
Well, the trumpet plays, the knight in shining armor shows up. It's the renovation night, and I might have to take that.
You may have to.
I might have to take that. And you come in and you save the day, because now we flip this to a renovation deal, factor in these necessary repair items, save the deal, and then you can always refinance later, get out of the renovation loan. Like you said, it's riskier, higher cost, and then refinance into a traditional loan once the work's done.
Yeah, and by the way, it's riskier to the banks and lenders. It's not riskier to the consumer.
No, but let's actually talk about that, if you will.
Right, go for it. This is your show, Joe. I'm just here to moderate.
You can invite me every week, man. I'd love to keep doing this. So let's talk. What if there is a risk of inhabiting the house while the work's going on?
Well, yeah. How does that work?
So depending on the program and the size of the project, they will allow you to actually finance in up to 6 months worth of your mortgage payment if your contractor / consultant, whoever's involved, says it's not safe to be in the property.
Way.
Boom, dude.
Today, years old when I learned that. So let me walk people through the scenario.
Let's do it.
So I have my apartment, or I'm living at home with mom and dad, or whatever the case may be. And I'm going to buy this house, but this house, it needs work, right? It's not safe to live there. I can theoretically, and it's that whole "it depends" thing. I can, as long as my contractor, works with me and writes the right statements, I can finance in 6 months worth of mortgage payments. So I continue living with mom and dad, or continue living in that apartment, while my home's being basically built. Oh, it's being rebuilt, right? Because there's a foundation and there's framework, but it's being rebuilt. So that way I don't have to worry about making the payments because I'm already paying rent. And then I don't want to have to pay rent and my mortgage payment. But the loan programs for certain people who qualify allow for that to happen.
That's it.
I love it.
There's more details to that,
Yes.
but that's the basic concept. So if contractor says, hey, for the first 3 months while we're redoing the foundation and we're putting a new roof on and we're fixing the gas lines or whatever it might be, you don't see that too much here, but you can't live here. It's not safe for 3 months. You can finance in whatever amount up to 6 months that they tell you. I mean, that's game changing.
Is that home style and 203K?
So the 203K standard product, because there's a limited and a standard, and the conventional programs also allow that as well.
Now there's like weird nuances, and this is just kind of like an opportunity for us to throw stuff against the wall. So like ideas, thoughts, answers to questions people normally would have. Can I put a pool in with a renovation loan?
You can with certain renovation
So
loans.
it depends.
It depends.
Okay. So
That's
like
it, 2 words.
So FHA 203K,
Repair or remove.
I can fix a pool or I can remove a pool,
Can't install it.
but I can't install it. Home style renovation.
The conventionals will.
The conventional will let me put a pool in.
Correct. So obviously we're in Florida. It gets hot in Chad. You know what I mean? It's hot here. People want pools. Now I mentioned earlier about during the time of the pandemic and things were taking longer. So these programs also have set time frames that you have to get the work done. And that could be as short as 60 days for VA and up to 6 months is usually the longest. Your contractors have to put in good faith and test that they're going to get it done within this time. So pool installations, huge. Everyone in Florida wants them. You love the house. You love the community. It doesn't have a pool. And everyone goes, I really want a pool. Don't walk away from the house. We can still help you get it in there. One of the challenges that we faced before was pool contractors not giving the confirmation they could do it in 6 months. Cost of material, cost of labor, time, whatever. So that leads into where it's important from the mortgage professional standpoint to really understand the product, the timelines, get with your renovation teams. I'm super happy to kind of boast on the cross-country mortgage renovation team.
Pimp out.
Brad Smith and the team there have been absolutely fantastic. They have made changes where changes are needed. The team continues to grow. We offer just top-tier customer service on the renovation side. So when things do get complex, if you will, complicated, we have an entire team dedicated to dealing with vetting contractors and dealing with draws and dealing with post-closing everything scenarios, so that when we're working with our real estate professionals and with our clients, we just focus on buying the house.
Yeah. I think it's good to know for consumer, originator, and the real estate agents representing the home buyers out there that yes, this product has more complexities. There's more moving parts. Therefore, there's more opportunities for frustration. But like, take a deep breath, take a step back, and keep your eye on the prize. The prize is what you're getting.
100%.
Right? You're getting the neighborhood you wanted.
Right.
You're able to negotiate a fair price to buy the home because the home needed repairs. Then you found a loan that let you actually do the repairs. And I remember telling one of my best friends when he was buying his house and he did a 203K, and this was now 15 years ago. I'm like, I won't do it. So I won't do it because I don't want you to hold it against me that you didn't like the process of basically buying a shell and having to go through the construction process. Because anyone who's doing a home remodel, I'm going through a bathroom remodel right now. It's frustrating. We literally haven't had our master bath for over 6 weeks because it took 3 weeks for the glass to come in. And when the glass came in, it didn't pass inspection. So now we're back waiting for another piece of glass to come in. And I'm not mad at my contractor. It's not his or her fault. It's just frustrating that I'm still having to walk upstairs and share my children's shower when I want to shower. So I let people know up front, keep your eye on the prize. Understand it's going to be a little bit more frustrating, only because there's more moving parts, only because that's just the way of the world that we live in anytime you're doing a bunch of construction. And I kind of use this analogize and use analogy, whatever, of raising a puppy. We're dog people in my household. We love dogs. Puppies are a lot of freaking work. But if you get a good puppy and you hand raise that thing, by the time it's a year or two old, you have the most amazing dog that you're totally connected with. To me, that's always been renovation lending. I could go and get another dog that's 4 or 5 years old, and maybe that dog works for me, but it wasn't mine from the get-go. Whereas that reno loan, That rental loan to me is like raising a puppy. It's like, okay, I know I had to go through certain moving parts, that certain stresses that maybe if I bought a resale that didn't need work, I would have had to go through, but I didn't get to pick out all the things, the flooring, the paint colors. I didn't get to remodel the bathroom. I didn't get to add that addition. I didn't get to knock that wall down the way that I always wanted to. And had I been able to, I wouldn't have had the money. Like if I didn't go that direction.
Sure.
So that's always a caveat that I throw out. As an originator, you obviously have more experience than I do, but that was how I would try to explain it to someone who didn't have experience.
Well, and it makes a lot of sense what you're saying. So what we try and do, and this is more as we're in the trenches, as we're talking with people, is we always try and lead with the positives.
Yes.
So the puppy analogy, I don't know if I can say this as well as you did, but
I think I butchered that one.
Right, it's the right idea. It's the right
Yes.
idea. So one thing that we've learned over time and over all these years is that there are certain things that may scare people away, whether that's a client or an agent or a listing agent or a seller when they hear renovation. So we try and lead with the positives, including avoiding things in listing descriptions and in conversations about renovation. It tends to scare people away that don't have that construction mentality. So to your point, the flooring and the finishing and the glass and the this and the that, customize and personalize. Those are the two golden words because it sounds uplifting. This is your opportunity to customize and personalize this house into your dream home. Make it what you want. That also goes a long way on listing descriptions when we talk, because we partner with listing agents when they know they have a distressed home or a home that needs to be updated. So leading with the positives, because no matter what, it is objection city. If somebody's not listening to this podcast or any of the other talented renovation specialists in the area that they could be listening to or online, it is objection city. I can't tell you, Dio, how often I hear, ooh, I heard terrible things about the 203K. Oh, it takes too long. It doesn't work out. It's too much of a headache. Why? Chances are, maybe this is a real estate agent who heard from another real estate agent that worked with someone who said they can do it, but they really didn't have an understanding. They didn't have the structure built within their company and their organization to do it and have this flawless kind of execution on it. And so you get a lot of objections. We have to be ready to overcome those objections. And there's no better way than being educated. And that's where it starts. The better you know about something, the less that someone can say something negative to you about it.
The next objection, you should be like, are you a dog person?
There we go.
Hey, if you're a dog person,
let me write that down.
Would you rather a puppy or would you rather a dog that's 6 years old?
Right.
Okay. Regardless of their answer, even like, I want a dog that's 6 years old. They're already potty trained. They're already housebroken. I'm like, cool, but you didn't get to train them.
Right.
You don't know their commands. You didn't even get to name them. Like most people, by the way, would love a puppy. And what we're giving homeowners the opportunity or home buyers the opportunity is to get the puppy.
That's it.
And to raise it into exactly the type of dog with the name that they wanted, customized, personalized. We're going to have to find a way to put a bow on this, Joe. But I have another question because I can just feel them coming from the consumer. Hey, Joe. Hey, Dio. Hey, the Dio and Joe show.
There you go.
Oh,
let's go. Let's get that going.
Yeah.
I see that next year.
Once we get the TLOP brand totally launched, and
Dio and Joe.
we start doing like our sister show and this other like channel that kind of goes along with it.
We're going to need to trademark that real quick before someone takes it.
No, can I do a self-build? I don't want to use a contractor. I know what I'm doing. I've been in the trades for 20 years.
Great question. So we spoke about DIYers a lot. Self-help, as they call it, is typically not going to be allowed. If you are a contractor, licensed and insured, they're not going to make you go hire one of your buddies who's a contractor. You can do it with proper references and all the vetting. But if you're just someone who's handy, thinks you can do it, this isn't a project for you. Now, there's two things.
You almost said if you're a hack. I caught you. You're like, oh, if you're a hack. No, I'm joking. I would be a hack. I would be that guy that's like, well, in college, true story, in college, I did work in the Home Depot lumber department. And I did work in the Home Depot building materials department, but I would be a hack if I was trying to like renovate my own home.
Right. Or put on your own roof.
Or put on my own roof or do anything besides like a ceiling fan.
Right. Self-help typically, and even that, they really want a hands off, and that's for the red tape part. But there are two things, I know we got to wrap things up, but there's two things I want to mention. The first happens to be with the market. So, okay, great. Dio and Joe, we've been going over this. This is great. There's a lot of opportunity. We're getting excited talking about it. How does that now correspond to the market we're in and where we're going? When rates at some point, as they keep changing it, will improve, we are going to see demand go up. We're going to see the demand for housing go up. We're going to likely see the housing prices increase, especially those turnkey, those new construction homes ready to go. That's what everyone wants. So again, having the opportunity to get a home that doesn't have as much excitement around it and you create it is going to give you a great opportunity to still get in a market where pricing is going to go up, even with rates down. And so here's the second part to that is that even if you don't use the renovation to buy your house, the house is livable, it's insurable, you can get in there, maybe it's just cosmetic, minor things, you can refinance with a renovation loan. So it's never too late. It's never too late.
Coming out of left field.
Telling you, man, I had to finish with the knuckleball.
Yes.
Let's go. So you can buy your home, live in it, and turn around and do a refinance. Add in the cost for your renovations. Now you don't have to worry about a seller. You don't have to worry about timelines and deadlines. Maybe some construction stuff, but you don't not contract stuff with a purchase. And you know what? 6 months or a year later, you probably have some equity in there, thanks to the renovation work you did. You want to pull some of that equity out and go buy another home, do an investment. You just built equity into the property with the construction that you did, with the renovation you did. Do a cash out refinance. Take money out of that equity, and now that you did all this, and go buy yourself another property, invest back in the market.
Yeah, now you're getting some real TikToking, house hacking shite.
There's a lot available. There's a lot that you can do with these.
But I love that idea that people need to understand this isn't just to purchase properties.
Right, correct.
Like that was a good reminder even for me. Like, wait a minute, I'm thinking purchase. Like, no, purchase it. Maybe you do a conventional loan. Maybe you put 5% down. Maybe that's because the seller was a turd. The agent wouldn't even respect your offer, so you had to go that way. It doesn't mean that you can't turn around and refinance out of that home loan back into a renovation loan and then do all your renovations.
One of the number one objections is the time it may take to close a purchase transaction with the renovation. Normally, we prepare people 45 days or so. You have a contractor involved. You got to get an estimate. We got to do all that stuff. So we say a little longer. In a competitive market, the last thing you want to do is go up and say, I need 45 days. Or a lot of companies that will very strictly say you need 60 days. You go to that when there's 10 other offers on the table.
Yeah.
You're not going to get it. So don't lose the home. Let's find a creative way of doing it, and refinance is the way to do it.
No, I love that. And then I'm going to leave everyone with this thought, including you. I'm going to first start with a little trivia question. And we covered this on our previous episodes. I don't know if you're caught up on your TLOP episodes there, Minglardi, but do you know who owns all the real estate in the United States? And you can't say Warren Buffett. You can't say Bill Gates, and you can't say hedge funds.
You're knocking off.
Yeah, I'm not.
Right, hit me with it.
What is it?
Hit me with it.
Boomers.
Oh, okay.
Baby boomers. Yeah. They own the majority of the real estate, right? Those are people born, was it like 1942 to 1960, I want to say. Those are the people who've been living in their homes for 20, 30, 40, 50 years. They have tons of equity, may even have the homes totally paid off. But what they haven't been doing, because they're most of them operating on limited funds or fixed income, which I always love that. I'm on a fixed income. I'm like, so's the cop, so's the teacher. Like most people that aren't in sales or aren't entrepreneurs like you and I are have some kind of a fixed income. Now, what a retiree can tell me, I'm on a fixed income that's a lot lower than what I used to make. Cool, now I get it. But that's a common, I'm on a fixed income. So these people are on a fixed income. They haven't been doing the updates. They haven't been doing the maintenance. And we all know that, there's two guarantees in life. It's death and taxes. And unfortunately for their families, those people's lives are going to expire. And when they expire, there's going to be these assets that someone gets to inherit, but they also get to inherit the tax bill, the insurance bill, and about $50,000 to $100,000 of deferred maintenance. Yeah. Or that person who inherits that property is puts on the market and lets your buyer, who you've already pre-approved for renovation loan, come in, make whatever offer they're going to make, even if it's 5% below market, because the people inheriting the property don't really care. They're just happy to get this asset off of their books. They cashed it out. And then all of a sudden, that person can come in and drop the $50,000 or the $100,000 in renovation, buy the location, buy the neighborhood, and get the home of their dreams without having to go compete against 8 or 10 other offers. And I think it's for all parties involved, home buyers to get excited about, loan officers to want to maybe learn this product a little better than they do, and realtors to want to understand this product and accept this product, because the largest generation of home sellers out there are the baby boomers, and they own a lot of real estate, and that real estate isn't necessarily the most updated. There's a lot of deferred maintenance. So for that reason, I would tell all people, yes, this was a very timely episode. So on that note, Joe, how do people get a hold of you? If someone wanted to ask you to step up and either save a deal, help you step up and show someone that yes, they can, or find a way to yes so they can become a homeowner, what's the best way to reach Joe Minglardi?
Awesome, Dio. Thank you first for having me. I really appreciate it. Joe Minglardi Mortgages on social media. You can find me on Facebook, Instagram, all the social media platforms. Joe.Minglardi at ccm.com, Cross Country Mortgage. And that's probably the best way.
Beautiful. Anything else to leave?
Renovations. Don't miss the opportunity. Let's go.
All right. Awesome. Hey, he's Joe. I'm Dio. That is all the time we have for you today, but we do look forward to catching you on the next episode.